All right, let's get some insights on the broad news that's shaping markets. For that, I want to welcome in Dale Smothers, President and CEO of RDS Wealth Management. Dale, thank you so much for being with us today. All right, we're just looking at the S&P 500. It held on to that 6,000 level, pushed a little bit higher. It feels like, if you compare it to football, we're gaining inches in terms of moving the ball down the field. What do you think is driving now this continuation of bullish sentiment that we're seeing?
I think overall the U.S. economy has a bullish sentiment around it because of what could come from these tariffs talks. I mean, the tariff talks themselves could generate a lot of optimism around how America is treated in the global trade. Hopefully we have a little bit of our intellectual property that is also protected along the way with this Chinese tariff agreement. Long story short, I think that the market as a whole is going to probably see a little bit of a restraint around that 6,100 point mark. And breaking through that could lead us to new, even greater all-time highs. But any kind of bad news or not extremely optimistic news at that 6,100 mark is likely to make the market pull back just a little bit. And we could see a restraint of 6,100 and a support somewhere around that $5,800 or 5,800 point mark rather, which would cause a lot of panic in the market if we don't have a lot of this trade war behind us.
Let me ask you, speaking of that, right before these high-level meetings occurred between the U.S. and China coming together in London, there was a little bit of concern about where things were, and the Treasury Secretary, Scott Bessent, had said things had stalled a bit, but now it looks like they're moving forward. Are you expecting a lot from this, and do you see this as a positive?
Scott Bessent has a hard task at hand, if you will. I mean, theoretically, he's there to try and sell U.S. bonds. I mean, that's his number one goal. So the reality is what I think is going to make the market move one way or the other is kind of how the Fed reacts to this. We've got CPI coming out tomorrow. That's going to be all eyes focused on CPI, making sure that, if we have less than 2.5 on the CPI, I think we're in good shape. If we see it creep above 2.5, inflation could be a little bit of a trouble for us. My personal view is that inflation's not going to be as big of a deal from these trade negotiations. We've already seen China with a net positive, even in the 90-day reprieve. What came from that was as much as a 20% positive in our favor, less tariff on our goods sent there and more tariff on their goods sent here. All in all, I think it's a good thing for the market.
What fuels your view that CPI is not going to come in hot tomorrow?
Yeah, so I think that inflation has been kept at bay because tariffs have been more of a demand destroyer than you may otherwise think. Clearly, with the same demand and less supply, we see inflation. But with less supply due to the technicals of tariffs, and people don't want to supply as much, the same way, whenever something that is made, let's say in America, or less tariffed right beside that product that's right beside it, the one that is tariffed, most of the consumers are selecting the one that has not been tariffed. Less demand on the items that have been quote unquote tariffed, therefore keeping prices a little bit lower than what we may have expected 2 months ago.
I believe you're forecasting 2 rate cuts this year. Are you still forecasting that?
Yes, ma'am. Yeah.
So when do you see that occurring, and what fuels that view?
So if the CPI comes in looking good, I don't necessarily see us seeing a June rate cut. I do think it happens before the end of summer, and I think we can probably see one again in fall, sometime maybe leading into winter. This rate cut of 25 basis points 2 times is going to validate what the market has kind of already priced in, if you will, and that could be what takes us past that restraint level. What fuels that sentiment is that currently we're seeing a Fed that's in a wait and see mode. They don't know yet whether or not labor is going to become weaker. They don't know if inflation is going to rise. So I think the print that really tells us this one coming out tomorrow is not as big of a deal for us because it's what happened in May. But what we are looking for is July's print that will tell us what took place in June, and that's really the the key indicator of what
that's
CPI.
where the rubber hits the road.
That's where the rubber hits the road.
Let's talk. I know you have some stock picks for us, and two of them in the Mag 7. One of them has been an underperformer compared to the group, and that's Apple. Worldwide Developers Conference, not a catalyst, and I was reminded that it's not historically a catalyst for shares. But why are you bullish on Apple in the context of its performance compared to the rest of the Mag 7?
So the Mag 7 has kind of brought us back up to where we're, like you said, right off of our all-time highs, except Apple and Amazon. They've kind of lagged behind. And a lot of that has to do with this hinge pin of China. Whether or not China is settled is going to determine a big part of Apple's business structure. And not only that, but you've got the antitrust legislation that is facing Apple. So those two things are kind of variables, if you will. I think the big one is China. When China gets settled, I think we're going to see Apple take off and catch back up, if you will, to the Mag 7.
Okay, and you still like Nvidia.
Still a big player in Nvidia.
Okay, and why do you like it from here?
Long-term, Nvidia is a strong play. I like to use the analogy of AI being maybe a gold rush, if you will, and Nvidia sells the pickaxes and the shovels. Whether Apple or Amazon or Meta or whoever it is wins the AI race, Microsoft, Apple, there's a big contention there. They're both top horses, if you will, in the race, and whoever wins, Nvidia comes out to be good on either of those two directions.
Yeah, well, Nvidia has made quite the recovery over the past month to now positive for the year. Yeah.
Sure.
Let's talk a little bit about CoreWeave. That's also on your list. Is this an Nvidia play, basically, to some degree?
Yeah, so extreme volatility in this name, and I would tread lightly here at the levels we see it trading at today. You're going to see that volatility, but long term, I think CoreWeave is a strong contender in the AI picture. I'll use another analogy here too, Diane. I like this with horse racing. Imagine that those top horses, Amazon, Apple, Meta, those top horses, they're all racing, and they're racing on what we may consider the track, which is Nvidia. And it just so happens that those horses race faster, they run faster on the track of Nvidia that makes the computer chips. CoreWeave enters in, and CoreWeave is essentially the horse trainer, if you will. We'll take it to Churchill Downs, where I'm from in Kentucky. Churchill Downs has a backed horse trainer, and this time let's say it's Bob Baffert. That's CoreWeave, and they're going to be there, I think, in the long run. Nvidia's got a big play with CoreWeave's movement here recently as well.
Yeah, so, and CoreWeave, look, to your point, I mean, it's up more than almost 300% year to date.
Incredible.
So
it's a little overpriced.
IPO,
off the back of an IPO, it's a little overpriced at this point, but if you buy in for the long term, I think it's safe. If you see that creeping back into the 120, 130 range, I would definitely be buying that particular stock if it fits your portfolio.
Okay, so pay attention to the potential entry points there. And then you've got an idea on your list for an investor seeking, say, a more conservative approach,
Absolutely.
and that's an ETF. PJAN is the ticker there, the Innovator Equity Buffer ETF. Tell us about your views here.
Yeah, so Diane, one of the key components of what we do for our clients is we help them go through retirement with a little less volatility. Clearly, we want income in retirement, and oftentimes we find ourselves selling in the dips, if you will. This particular now, granted, we do our best to not do that, but if you're not careful, you can find yourself selling in the dip for income in retirement. This particular position, it decorrelates on the way down. It gives us as much as 15% downside protection on the S&P 500. So what it is a packaged group of options where you are purchasing the S&P 500 on an options platform as opposed directly into the S&P 500. Gives you 10 to 15% upside potential and as much as 15% downside protection.
Potential, because I mean, in terms of, it does feel like very risk averse, that one. When I just looked at its performance year to date, it feels like you might even do better in bonds. Fixed income.
So the thing is, if the S&P, it's tied directly to the S&P 500. So if the S&P 500 is up 10%, and let's say that cap on that option is 12, you'll get the full 10.
Okay.
If it's at 15, however, you're only going to get 12.
Got it.
So starting back in January, and the reason we picked that January right now is because the S&P is up a little over 2% currently, gives us about 17% downside between now and January, because that option expires in January, and it still gives us close to a 10% upside if the S&P continues to climb.
So its beta is close to,
That's exactly it.
Okay. All right. Thank you, Dale.
Yes,
That's
ma'am.
Dale Smothers, RDS Wealth Management. We appreciate Dale for joining us today.